All right, everybody, it is 10 o'clock. I'm going to give everybody about another minute before we get started, just to make sure everybody who wants to be here is able to get in. Thank you guys so much for being here, and I'll get started here in just a minute. Okay, it's been about a minute, so I'll go ahead and get started. If anybody comes in late, we can just, fill them in or whatever. Thank you guys so much for being here. Thank you to Citizen Potawatomi Nation for having us back again. I'm going to kind of start out. My name is Sara Lorenzen. I work for the Oklahoma College Assistance Program, which kind of long story short is a division of the Oklahoma State Regents for Higher Education. We started out as the Oklahoma Guaranteed Student Loan Program. So student loans is kind of what we do. So what we're going to talk about today is what I like to call the life cycle of a student loan. That is everything. We're going to touch just a tiny bit on when you're in school and you're taking out a student loan and what that looks like. And then we're going to talk about repayment pretty heavily, what your options are. If you get into problems with how to pay your student loans, what to do there, and what those options kind of look like a little bit. I'll touch a little bit on forgiveness programs, but if you're interested in like public service loan forgiveness, on Friday at 10, I'm actually doing the last part in this series, which is going to be specifically the whole time on public service loan forgiveness. So I'd go to the Facebook page or go back to Eventbrite and register for that one, so you can join us for that if you really have questions specifically about public service loan forgiveness. So I'm going to go ahead and get started. Just a couple housekeeping things. If you have any questions, go ahead and throw them in the chat. I will stop periodically just to check in and see if anybody has any questions. If you can, keep your mics on mute just so we can make sure everybody can hear. And yeah, let's get started. So there we go. Okay, so if you were here on Monday, my coworker Letha talked to us about funding your college education, how to use grants, scholarships, things like that. And she used this awesome ice cream cone, which is probably one of my favorite graphics that we have to use, just because I really wish that someone had showed this to me when I was in school. And, it would have made a lot more sense of how the quote unquote smart way to fund my college education. So the way we like to say is the biggest part of that ice cream cone should be your gift aid. So any kind of scholarships or grants that you can get a hold of that are free money. So stuff you don't have to pay back. And then the next part should be equal parts earned money. So this is going to be work study or a part-time job or a full-time job, depending on your circumstances. And then any saved money you have. So if you are straight out of high school and you have, parents have saved money for you, or if you've saved money for yourself, that's going to be the bulk of what you want to pay for your school with. And then if all else fails and you have nothing else to pay for your school, then you want to consider student loans. They're definitely not a bad thing. They are an investment in your education and being able to kind of get where you are. I have probably way more of them than I should, but I don't regret any of it, because I wouldn't be able to do what I'm doing today without the education that I got. So Let's kind of move on. We'll touch on this. Letha also talked about the FAFSA. The FAFSA needs to be filled out every single year that you're in school. It comes out October 1st every year. So right now, the application for the fall is already online. You'll go to studentaid.gov and you can go, there's a fill out the FAFSA, apply for aid section. You go there and fill out your FAFSA. You'll need a couple of things, but this is going to be your free application. You should never have to pay for it. But it will tell you how, or you walk through it, you will apply for grants, work study, and student loans. When I say apply, that doesn't mean you're going to take out student loans. This just kind of gauges your need, whether you need student loans, whether you need grants, whether you need work study to help you pay for school. So in order to do that, you need a few things. You're going to need your tax returns and your W-2s. You're going to need your, to go to either FAFSA.gov, which you can still do, studentaid.gov, or they have the My Student Aid app, which is really helpful. And I've had a lot of students tell me that it's actually a lot easier to use than trying to use the website because it only takes a couple of seconds to fill out everything. Also, and I don't have a screenshot of it here, but when you do go to fill out your FAFSA, they do have what's called the IRS data retrieval tool now, which helps quite a bit in my opinion, because as long as you filed your tax returns, it pulls all of the information for you. Now you have to be really careful to make sure you're putting in like the right address and everything that you had on that tax return that it's pulling, so it will identify you correctly and pull your information. But if you can do that, it will pull out of the information for you and it makes it super duper easy. You're also going to need your FSA ID if you don't have it already, and you're going to need your social security number. All right, so fast forward, we have applied for financial aid. We've applied to school. And now the school is going to give you a financial aid offer letter. It used to be called an award letter, but we prefer to call it an offer letter because it isn't just an offer. You don't have to take any of it, or you can take all of it, depending on what you need to pay for your school. So this that you're seeing on the screen right now is just kind of a snapshot of what that would include. Now, most of these letters are going to be digital now when you come to school, but it's going to show you all of the grants you qualify for, all of the work study you qualify for, and then any loans that you qualify for. And you'll have to go in, or the student will have to go in and accept what aid they're going to take. Whether you're going to take all of the grants, you're going to take loans, that's up to them. If you're only going to take part of the loan, you don't have to take all of the loan. It's actually a common misconception that if you take out a loan, you have to take out the entire amount that they offer you, and that's not true. If you only need $1,000, you only have to take out $1,000. You don't have to take out, if they offer you $5,000, you don't have to take the whole thing. So I'd be really clear on what you actually need, as far as if you need it to pay for housing, or you need it to pay for books, or you need, you know, whatever. Make sure you total that up before you accept your financial aid offer. And that way you're not taking out more loans than you absolutely need to. Okay. And then once you've decided, yes, I'm going to take out a student loan, you're going to get what's called a master promissory note from your financial aid office. What this is your promise that you are going to pay your loans. It has your loan repayment terms in it. It has your interest calculation of over the course of the loan, what you're going to pay. And then it also gives you the information about deferring the loan or loan cancellation and all of that kind of stuff. So it's a really, really, really important that you read this over before you do that. Okay, and this is just a snapshot of what the end of the master promissory note looks like. This is usually digital now. It used to be on paper. So it's really important that you read it. There's a specific section D, the promise to pay, that talks about how basically the government's going to get their money if you sign this and you take out this loan. So you're promising that you're going to pay back the entire amount. So make sure that you read through this really carefully. I know it's a lot of fine print, but definitely make sure that you read it and you fully understand what you're signing up for. Because at the end, you have to sign this fun thing that's in red down here, which says that you agree to pay in full all of your loans under the terms of the NPN. And we'll talk here in a minute why that's important. And that you've reviewed all of this information, because if you come back and say, well, I didn't know that it said that, well, you had the information to read it. So it's really, really important that you look through all of that. All right. Now I see a couple of things in the chat, so I'm going to answer. All right. At what age can students file based on their own income instead of their parents? That kind of depends on their situation. So I would definitely talk to their financial aid office to know for sure, but general rule of thumb is around the age of 24 if they are not married. If they are married or there's other circumstances like that, that would change that circumstance. But I would definitely make sure to talk to their financial aid office if you have any questions, because they can tell you for sure whether, that's accurate for their school or not. All right, so on to the next. There's two different kinds of student loans. The majority of what I'm going to be talking about today is federal student loans. Private student loans are something you're going to get from a bank, or if you see the refinance options of like SoFi and other, bank type places that offer student loan repayment. Those are going to be your private student loans. But we're going to talk a little bit kind of about the difference between them so you understand as we're going forward. So federal student loans, repayment starts once you either drop below half-time, which is below 6 hours per semester, or you graduate or withdraw. They usually have a fixed interest rate that's set by the government. Unless it's a plus loan, which is generally a parent loan, and I'll talk about that more here in a minute, they don't require a credit check. There's several different repayment options, and they allow for deferment and forbearance if you have, some sort of circumstance that prevents you from paying. And then some of them are even eligible for forgiveness or cancellation, depending on your circumstances. Whereas private loans, some of them do require you to start paying while you're in school. They do have sometimes variable interest rates. Sometimes they're higher. Right now, I've seen a lot that are trying to be competitive with federal student loans, so they've lowered the interest rates. But that doesn't necessarily mean that it's the better option. It's really going to depend on what your personal circumstances are. Sometimes they can require a cosigner. They almost always will require a credit check. They rarely have flexible repayment options. So that's not to say that there's anything bad about taking out a private student loan, especially if you have. But just understand that you may not have as many options if you lose your job, or if you get sick, or if you decide to go back into school, or whatever. Whereas a federal student loan may give you more options with that. And they are also not eligible for any student loan forgiveness or cancellation programs at all if they're private student loans. Okay, so I'm going to talk a little bit about the different types of federal student loans, because there are several. So there are direct subsidized loans. These are need-based, usually for undergraduate students. Department of Ed pays the interest on them while the student is in school. So you would not have to start accruing interest that you are responsible for until after you graduate or drop below half-time. And then there's direct unsubsidized loans. So very similar, it's non-need based. So if you don't need it, but they offer it as an option, you can take this out. The borrower is responsible for all of the interest. So if you take it out your junior year of college, you start accruing interest from the moment that they disperse your loans. You don't necessarily have to pay it while you're in school, but when you graduate, it's all going to capitalize. So if you took out $5,000, it may actually look a little bit higher once you start repaying, because you're going to have all of the interest of that 2 years or more, depending on how long it took you to go through school, capitalized on top of that $5,000 you initially took out. And then if you do any kind of deferment or forbearance, the interest is not subsidized. Whereas if you had a subsidized loan and say you lost your job and had to take a forbearance, which I'll talk about again here in a minute, the subsidized loan, the interest would be paid by the government during a deferment. Whereas the unsubsidized loan, it doesn't matter the circumstances, it will still continue accruing interest. All right, and then there are direct plus loans. These are non-need-based loans, meaning, you know, the FAFSA has told us that you don't financially need this money, but it's offered if you decide that you want to take it out. It is for dependent undergraduate students for their parents to take out, or graduate students can take them out for themselves. The parent is responsible for the interest and possibly the payment. It's going to depend on the terms and what loan you've taken out as soon as the disbursement happens. So that's going to depend. You're going to need to talk to the financial aid office to get the specific details as far as that if you decide to take out a direct plus loan. And then the grad students are responsible for the interest while they're enrolled in school. So that doesn't mean that you have to pay it while you're in school, just like the unsubsidized loan. It just means that the loan is going to continue to gather interest while you're in school. So whenever you graduate and you get your master's or your doctorate or whatever, that interest is all going to capitalize at the end of the loan. And it is the only federal student loan that requires a credit check. Because it is a plus loan, because they figure at this point you don't necessarily need it, so they want to make sure that you qualify and you're good to pay it back. Okay, and then these next two actually don't exist anymore as far as we don't issue them anymore. However, if you're like me and you went to school prior to 2017, some of these do still exist. So I want to talk about them because I don't know what type of loans you guys have, but it is possible that some of you guys have these type of loans. So there were federal Perkins loans. Those federal Perkins loans ended in 2017 when the borrower was not required to pay any interest while they were enrolled in school. It was a very, very low interest federal student loan for undergraduates or graduates that had exceptional financial need. And it's not eligible for public service loan forgiveness. Although, and I'll talk about it here in a little bit, there is a cancellation program for Perkins loans, but it's very specific in the terms of it. All right, and then there are federal family education loans, or FFEL loans, as they're called. This program ended in 2010. It was a program that worked with private lenders to provide educational loans that were guaranteed by the student government. They were federal Stafford loans, subsidized, unsubsidized, and plus loans. These specific loans are not eligible for public service loan forgiveness. And they're kind of tricky, to be honest with you. There are two different types of these loans. There are FFEL loans that are held by the government. So this would be they are still FFEL loans, but the Department of Education has them. And then there are FFEL loans that you got through the government, but they're still held by private people. So, you know, private banks. So that's super confusing, but just so you understand that there is a difference. Okay, so now I'm gonna stop talking for a minute, and I'm actually gonna let you listen to my friend Jordan, who used to work for us, but before he left, he did this great video, and it talked all about the repayment plans. So I'm going to let him talk for a minute, and then I'm going to come back and we're going to talk about it some more.
The sound's not playing, Sarah.
Hold on. Okay. Okay. Sorry about that, guys. Let's try that again. Can you hear it now?
Hi, I'm Jordan with the Oklahoma College Assistance Program. If you borrowed student loans and have been out of school for 6 months or more, you're probably making student loan payments.
Oh. Why are you stopping?
Hi, I'm Jordan with the Oklahoma College Assistance Program. If you borrowed student loans and have been out of school for 6 months or more, you're probably making student loan payments. There are several repayment plans for you to consider. In fact, there are 8 different options available. The first and most popular option for paying back student loans is the standard repayment plan. The standard plan is a fixed monthly payment that is paid over 10 years until your loan is paid in full. Using this plan often results in the least amount of interest paid over time. The next option is the graduated repayment plan. With the graduated plan, your payments start low and increase every 2 years. This plan also only takes 10 years to complete, but you pay more in interest over time. The third option is extended repayment. Extended repayment can either be a fixed monthly amount or a graduated amount, but the payments are spread out over 25 years instead of 10. This plan is only available if you have more than $30,000 in loans. Although it has lower payments than the standard and graduated plans, you pay more in interest over time. The next repayment option is income-based. This plan caps your monthly payments at a percentage of your income. The amount is adjusted every year when you submit your taxes. This plan is also spread out over 25 years, and if you make all your payments during that time, and if you still have loan balance, it will be forgiven. The next option is only for borrowers with Federal Family Education Loans, or FFEL. The plan is called income sensitive, and your payments are adjusted based on your gross monthly income. You have to renew this plan each year. While your payments may be low, this plan has extremely high interest cost, and it could take a long time to pay off your loan. The last 3 loan options are only available if you have direct loans from the U.S. Department of Education. If you're not sure who your loan servicer is, visit nslds.ed.gov to find out.
Oh. Apparently, I can't type anything in the chat or it will turn it off. So hold on, let me get us back to that spot.
Every 2 years. Only takes 10 years time. Repayment can either be a fixed monthly amount or a graduated amount, but the payment plan is only available if you have interest over time. This plan caps your monthly during that time, and if you still have loan balance, it will be forgiven. The next option is only for borrowers with Federal Family Education Loans, or FFEL. The plan is called income sensitive, and your payments are adjusted based on your gross monthly income. You have to renew this plan each year. While your payments may be low, this plan has extremely high interest cost, and it could take a long time to pay off your loan. The last 3 loan options are only available if you have direct loans from the U.S. Department of Education. If you're not sure who your loan servicer is, visit nslds.ed.gov to find out. The first direct loan repayment plan option is income contingent. Income contingent payments are the lesser of either 20% of your income or the amount of a fixed 12-year payment. The payments are recalculated each year based on your income, and your monthly payments might be higher than it would be on the 10-year standard repayment plan. If you haven't finished paying your loans after 25 years, the balance is forgiven, but you may have to pay taxes on that forgiven amount. The next option for direct loan repayment is the pay-as-you-earn plan. The payments on this plan are 10% of your discretionary income, which is recalculated every year. For this plan, you must be a new borrower after October 1st, 2007, qualify for financial hardship, and have a high debt level relative to your income. The final option for direct loan repayment is the revised pay-as-you-earn plan. The payments on this plan are also 10% of your discretionary income, as calculated each year. But when you have made 25 years of payments, the balance will be forgiven. You may be taxed for the forgiven amount. While there are a lot of options for student loan repayment, only you and your loan servicer can decide which option works best for your situation. Your loan servicer is there to help you evaluate your options and make the best choice for you. For more information about managing student loans and borrowing smart from the start, visit readysetrepay.org.
Okay. Sorry for all the technical difficulties, but thanks for sticking with me through that. And it did say nslds.ed.gov, but as of about a month ago, that has actually been updated. So in order to get to all of your information, you would go to studentaid.gov. And I will talk here in a little bit about that and kind of show you what that looks like now, because it looks a little bit different than NSLDS. So let's go ahead and kind of move on. So here's a breakdown of the repayment plans that we were talking about. So standard fixed payments, 10 years. You can pay less over time as far as interest goes, but it does not qualify for PSLF. This is your standard, like when you sign that you're going to pay for your loans in undergraduate, this is the most common plan, is that you pay it over 10 years. There is the graduated plan, as you said, the extended repayment plan, and then the revised pay as you earn here on this slide. And there are only 4 payment plans that qualify for public service loan forgiveness. So you'll kind of see that I've noted on these which ones don't qualify. And again, if you want to join me on Friday, I'll talk a lot more in detail about all of this. Some of these, if you see them where it says that the balance is forgiven after 20 to 25 years, with those plans, the forgiveness is taxable. So be aware of that when you're getting on that plan, that yes, they will forgive it after 25 years. You'll have that. All right, I see in the chat box, does FAFSA show you what you are awarded anywhere? Yes, you would get it doesn't show on your FAFSA, it would show on your financial aid letter, but then it would also show on studentaid.gov when you look at your aid summary, and I'll share that with you here in just a minute so you can see what that looks like. All right, and then here's the rest of the repayment plans. There's pay as you earn, income-based repayment, income contingent repayment, and income sensitive repayment. So the 4 plans that do qualify for public service loan forgiveness are the revised pay as you earn, income-based repayment, and income contingent repayment. Any of the others do not qualify, but there are several others that even if you don't qualify for public service loan forgiveness, that they will forgive the balance. Now, something I want to make mention of, because there's a common misconception with public service loan forgiveness specifically, and this is the only time that this counts. If your balance is forgiven with public service loan forgiveness, it's not taxable. But any of these other repayment plans where it's forgiven, it is taxable. So just kind of be aware of that. All right. And there was where I was going to stop for questions, but I've been kind of doing my own thing. So, all right. So this is a look at studentaid.gov, what it looks like right now. So if you pull it up on your screens, this is what it is going to show you. Here where it says log in is where you would log in. You're going to use your FSA ID that you would use at, to log in to get your FAFSA. When you do it, it's going to give you a bunch of different options. This is if you're trying to find the best repayment strategy. So if you're on the standard repayment plan and it's just way too much for you to handle and you're trying to find some other way to repay your loans, you would go here, you'd sign in. It'll show you a screen that has all of your age summary, which I'll show you here in a second. But you'll go to this, finding the best repayment strategy. It gives you a bunch of different options. This one that I've shown you is just the, I want to find the best strategy, but they do have the, I'm struggling with payments, or I'm going to borrow money and I want to see what that looks like. So this will then take you and ask you a bunch of questions. So You're going to answer all that apply to you. So if you have a job, if you file taxes, if you save for retirement, if you are married or you're engaged and about to be married, if you have any additional taxable income, you put in all of this stuff, and then it'll go and it'll ask you questions based on that. So for this purpose, we're single, we live in Oklahoma, and then it's going to ask you for your yearly salary. It's going to ask you if you're expecting to get any kind of income growth, if they give you, 2% cost of living increase or whatever. And then it's going to have you review your current loans. So this is what you'll see not only when you log in, you're going to see a screen that looks like this, but you'll also see this when you're going through to find a repayment plan. And it's going to show you your subsidized loans, your unsubsidized loans. In this little circle, it's going to show the balance of your loans. And then it's going to show how much you've actually paid off to date, the average interest rate of your loans. And then if you have any other loans, you can add them in here if you're wanting to consolidate and you're wanting to kind of see what that would look like to get them all together. It's going to ask you if you're interested in public service loan forgiveness. What it'll do is it will take an inventory of that, and it'll take that into account when it's suggesting a plan for you. All right, and then you're going to talk about your goals. Is your goal to pay off the loan as soon as possible? You want it out of your hair, you don't want to worry about it. Do you need to have a low monthly payment? Do you want to pay the lowest amount over time? Meaning I want to pay the least amount of interest over the course of the loan. You go ahead and you select one of those options, and then you hit view results. And what it's going to do is it's going to show you what your monthly payment would be on each of the plans. It's going to recommend, this is the plan that we think, based on the information you put in, what is going to be the best plan for you. Now, the amount I put in when I did these screenshots, this was just, I think it was like 12,500, which is right around the average that most people in Oklahoma take, depending on what school they go to. So we would kind of see this. So in this scenario, the best option was income contingent repayment. We were seeking PSLF. So this is what we would be looking at. Monthly payment, approximate monthly payment. Now, when you talk to your servicer, it may come out being a little bit different, but it gives you kind of an estimate of what you're looking at. The total amount you'll pay, your estimated payoff date, and what your forgiveness amount is if you qualify for PSLF, what the actual amount that they would be forgiving looks like. But if you look at that and you're like, that really doesn't look like it's the best option, down at the bottom, you can hit view and compare all plans, and it will actually show you all of the plans. This one doesn't, but it'll show you the different plans so you can compare them. You can compare the payments, you can compare the amount you're paying, the payoff date, the amount that's going to be forgiven. You can look at all of those options, and it tells you on each of them whether it's a good option for public service loan forgiveness or not. And that way you kind of know what you're doing. All right. All right, if two people in a household have a balance, do they take that into consideration? They do, but I've seen it a bunch of different ways. And honestly, if you have two people that are in the same household, I'd really recommend talking to their servicer about their loans specifically. Whenever you apply for an income contingent repayment plan, it is going to be based on your taxes. So if you both are filing your taxes together, it's going to take both of your incomes into account. So that's something to think about. Now, I'm not recommending this, but I'm saying that I know several people who are married who both have student loan balances, which because of their student loan balances, they file married, but filing separately. Because that way there is no weird, because one of them makes more income, or because their income amounts too high that it makes their payment more than they can afford. So I'm not recommending that, but I am letting you know that that is an option, that I have a lot of friends that I know are doing that with their spouses. So while I'm here at my stopping point, does anybody else have any questions up to this point?
I do.
Okay.
So can you talk a little bit about the difference in subsidized and unsubsidized. I mean, I'm pretty sure I understand that if it's subsidized, the government's paying the interest while you're in school.
Mhm.
And if it's unsubsidized, you're paying that. But what I don't understand, because I'm hearing different situations. So right now, we didn't understand all of this when my son started school. And so we
Okay.
did not know what he had gotten through the FAFSA when we filled it out. And so unfortunately, the financial aid office where he was going did not do any explanation, nothing. We had a really bad experience. Anyways, long story. But I guess he had been awarded a Stafford loan that we didn't know. It was just sitting in there like for him to accept it. Well, we didn't know. And so we did a private loan and we opted to make the interest payments while he's in school just to lower that. So that's what we're doing right now. He's in his second semester of his freshman year. So I understand how that part of it works. And from what I understand, that'll lower, our interest over the time because we're paying that off while he's in school. But I guess what I don't understand about like the Stafford loan, if he would have accepted that, we wouldn't owe any interest. But then once he gets out of school, is there still interest that's not paid? I guess is the part I don't understand about those.
Okay, that makes sense. Well, first, right now he would be taking out direct loans. They don't do Stafford loans anymore. They've changed the whole program, but that's a different story for a different time. So it's probably a direct loan. It may still have been called a Stafford loan. I've heard some people still use it interchangeably. But basically, yes. If you guys had taken out the Stafford loan, then you wouldn't have to pay the interest on it while he was in school. You definitely could still, and that's something that we usually recommend when I go out and talk to schools about, you're taking out a loan. I definitely recommend it, and kind of talk about why it makes it a lot cheaper over time. So I still think that that's a good idea, but you definitely wouldn't have to. In a private loan, they kind of set their own terms. The government tends to regulate these other ones a little bit better. So yes, if it was an unsubsidized loan, he would still be incurring the interest, but you wouldn't have to pay for it. It would at that point be voluntary for you to pay for it during school. Does that make sense? Does that clear it up any?
A little bit. I guess what I'm confused is you hear them say the government's paying the interest. So are they? I mean, does the interest go away and then you only owe the principal? I guess that's the part I'm confused about.
Okay. With a subsidized loan, really what happens is it doesn't accrue any interest. I highly doubt that there's, somebody in the government that is paying that every month for you.
Okay.
As far as I understand it anyway, a subsidized loan is it accrues interest, but you're not charged that interest because the government basically writes it off. And then an unsubsidized loan does the same thing, but that interest is not written off. When you drop below half-time, withdraw, graduate, that all of that interest that had accrued, instead of the government writing it off, it then gets piled on top of the loan for you to repay.
Okay.
Does that make sense?
Yeah, that makes sense.
Okay.
So my second question is it was called a Stafford loan. I mean, I don't know. That's just what it showed up as. And,
Okay.
And no one was like, you should take this first. We didn't know. So,
yeah.
I guess it wasn't going to pay. I mean, he didn't get a lot, but it wasn't going to pay for everything. And in my mind, I was like, I'd rather just have one loan, because you have to decide what you're going to need for the 2 semesters. So we declined that one. So basically, does that wipe out his chance to get that ever?
No.
Okay.
No. You can decline it one semester and then take it another. Like, just in my personal experience, I declined any loan options for the first 2 years. I was raised by a single parent, so thankfully I had lots of grant options for the first 2 years because my mom didn't make a whole lot of money. So I completely declined any loan options. She and I both worked extra jobs to help pay for that extra 2 years to make sure that I took out as little as possible for undergraduate. I didn't start taking out loans until my end of my sophomore year, beginning of my junior year. And that was only because I decided to move on to campus instead of living with her, and I needed something to pay for room and board. Mm-hmm. So it doesn't hurt his chances at all. Like if next year you apply and you decide that you're going to take out a loan at that point, he's definitely still eligible. Just like if you decided right now that you still needed that money, you could probably go back to the financial aid office and talk to them, and they would probably have some sort of option for you if you needed to take out that loan. Okay. So no, it doesn't hurt his chances because you guys took out a private loan for this semester. But yeah, I think that answered your question.
Yeah, absolutely. Thank you.
No problem. Okay, did anybody else have any other questions before I move on? Okay. Okay, so a couple of things to watch out for. There are, and actually my boss is on the call, Kelly Kellner. She's our Assistant Director of Outreach Services. She jumped on the call. She added to what I just said, and she said if you decline a student loan that you've been awarded, you can usually always get that money back anytime during the academic year. She actually used to work in financial aid, so she's probably way more the expert than I am when it comes to that. So there's the answer to your question. All right, so we're going to talk a little bit about kind of scams, red flags to watch out for, because with anything financial, you know, there's always crazy people that are doing things they're not supposed to. So just a couple of things to keep in mind. Nobody's going to ask you for an upfront payment or a monthly fee to manage your student loans for you. It's all free. You can do it yourself online. They're not going to ask for a power of attorney or third-party authorization to help you with your student loans. They're not going to request your borrower's FSA ID or password. If someone is asking for that information, just like any other kind of like hacking, identity theft information, nobody from a legitimate, resource is going to ask for your password and information. If they require any kind of credit or debit card information to get started on helping you with your student loans, not a good thing. Any kind of high pressure sales or time sensitive situation, like you have to do this right now. You can't stop and think about it and come back. If they dissuade you in any way from contacting your student loan servicer, saying they will manage it for you, big, huge red flag. If they promise any kind of immediate debt reduction or forgiveness or cancellation, like I've seen on Facebook ads for this Obama's debt cancellation thing, like that's not a thing. It does not exist. There are forgiveness and cancellation programs for federal student loans, but none of them are immediate. Like there's a process to all of them. Or if they tout a relationship with the Department of Education, your federal loans are through the Department of Education. So you will only deal with a certain number of servicers that the Department of Education has hired. You can actually go on studentaid.gov and find a list of them. So if it's not one of those, then it's not a legitimate source. So just kind of be wary of that as you're navigating this student loan situation. That there are some people out there that have less than great intentions. So make sure that you're keeping an eye out for that. And if anything feels sketchy about a situation, just don't do it. All right. So now let's talk about when you're struggling with repayment, because this happens. It's happened to me. I graduated undergrad in 2006. I got my master's degree in 2012. In the course of that, 17, 18 years now, I've been laid off twice from different positions. Had my ex-husband at one point when we were married, got laid off, and I ended up having to contact my servicer and get my loans put into forbearance or deferment because I couldn't make the payments. And the most important thing, because it happens to everybody, is to contact your servicer. Like, contact them at the first sign of trouble. The last time I got laid off, it was literally the first phone call that I made after I walked out of the building. Was I called my student loan servicer and said, hey, look, here's the situation. I just got laid off. I don't know how long it's going to take me to do this. Can I get like a 6-month forbearance on my loan just to make sure that I don't go into default? Because, you know, my priority at that time was going to be making sure I had a roof over my head while I was looking for a job. So, and they were fantastic. They said, sure, we can definitely help you. They are a lot nicer if you reach out to them first. I stress this to every student that I talk to about this. Talk to them first. They are a lot more willing to help you. They are a lot nicer to you if they don't have to track you down. So if you reach out to them first and tell them that you're having a problem, that is the best course of action because they can help you at that point. All right, so let's talk a little bit about some terminology that comes with this having issues. There is what's called delinquency. This starts from the very first day you miss a student loan payment. So if your student loan payment is due on the 1st, on the 2nd, your loan is delinquent if you have not paid. They sometimes, depending on how long it's been delinquent, if it's been delinquent more than 15, 16 days, they can report it to the credit bureaus, and they will. You need to speak to your borrower at the first sign of trouble. Now, that being said, I think I've had it where it was like a couple days off, you know, mine was due on the 1st and I paid it on like the 4th because that's when my paycheck hit. But as long as you are paying it as quickly as possible to get out of delinquency, the better. Obviously pay on time, pay early if you can. And then there's default. And you don't ever want your loans to go into default because it's a really big headache to get them out of default. So a loan is considered defaulted after 270 days of non-payment. Or if you have failed to repay your loan according to the terms of the master promissory note. So if the master promissory note says this is the amount of payment you're supposed to make, and you're only making half of that without talking to the servicer to get that amount changed that is due, that can cause you to go into default also. And then also failure to submit any on-time requests for deferment or cancellation. So in the case of what I told you about the last time I got laid off, if I had just not paid my student loan and didn't call them and ask them to give me a forbearance, then they could have defaulted on my loans if I just wasn't paying them. But because they knew that I wasn't going to be able to pay my loans, it made it a lot easier. It got it to where I wasn't in trouble because they knew I wasn't going to be able to be making my payments, or they knew I was going to need a lower payment. Okay, so here's some reasons why you don't want to default on your loan. So it can really mess up your finances. Wage garnishment, they can take your federal and state tax returns. It really damages your credit rating. Defaulted student loans can just really, really screw up your credit rating. And then you also, when you're defaulted, you lose any option for deferment or forbearance or any other financial aid. So if you, say, went to school for a semester and you dropped out because you had some family circumstances and that loan went into repayment and then you didn't pay it, and you went into default, and then you tried to go back to school to finish your degree, until you're out of default, you're not going to be able to qualify for any financial aid. So it is really, really, really important that you avoid default at all costs. Okay, so I said a lot about deferment and forbearance, so let me kind of break that down a little bit. Deferment and forbearance are basically the same thing, but a little bit different. So a deferment is what you're going to get while you're in school. You can get, if you lose a job, you can get it for several specific circumstances. And that's the biggest difference, is a deferment is for a specific circumstance. A forbearance is just if you're having a financial hardship of some sort and you need to not pay your loan for a period of time, you will get a forbearance. Another big difference is a deferment if you had subsidized loans, and this only counts for subsidized loans. If you had subsidized loans, a deferment will mean that those subsidized loans will not be accruing interest while you're in deferment. Or as we kind of explained it earlier, the quote unquote government will be paying for that interest while you're in either back in school or in your deferment. So there's lots of different options about why that can happen. So I would talk to your servicer if you ever get into that circumstance about the different options. Okay, so if you have defaulted, and I'm gonna go ahead and talk kind of quickly through this because we've got about 10 minutes left. The first option is loan rehabilitation if you are in default. That is making nine on-time full monthly payments in 10 consecutive months. Now, if your payment is $200 and all you can afford is $50 a month, but you're trying to get out of default, and this is just a made-up scenario here to try to kind of explain this concept, you would need to talk to your servicer and say, look, I am trying to get my loan out of default, but this is the only payment I can make. I can give you $100 a month. I can give you $50 a month, whatever the two of you agree to. You have to make 9 on-time full monthly payments. Now, if they're garnishing your wages, those don't count as voluntary payments. You have to physically pay them $100, whether that be through your online bill pay or whatever, if that's the agreement that you made. Once you've done that, then you will be removed from default. When you say on time, generally that means within 20 days of your due date. If you're going for PSLF, and I'll say this here in a minute, but if you're going for PSLF is 15 days is considered an on-time payment. And you can only rehabilitate your loans once. So if you fall back into default, you lose the ability to rehabilitate your loans again. So that's a one-time shot that they give you, kind of a freebie mess up and to fix it, and then that's it. Then your next option is loan consolidation. You can combine all of your loans into one repayable loan. Sometimes they'll do one repayable subsidized loan and one repayable unsubsidized loan, depending on your servicer, that is repayable to the Department of Education. This will take all of your debts and put it back into an active loan. It's not for everybody. Sometimes you can end up paying a lot more interest. It can affect the total amount of payments you make. It can affect your monthly payment amount. It can affect any loan forgiveness options you have, depending on what you're doing. And I did over here leave the studentaid.gov managed loans. You can look at the consolidation options, as well as there's a phone number to call if you're interested in that. Okay, so let's talk just briefly about some different forgiveness and cancellation options. So I've mentioned several times public service loan forgiveness. And again, I'll talk about that a lot more on Friday if you join us. But basically what that is if you are working in a government or not-for-profit public service job, you qualify after 120 on-time payments on one of those qualifying repayment plans. You qualify to have the remaining balance of your loans forgiven. There are several stipulations to that, and that's why we're having a whole section of it on Friday, because it is a little bit tricky. But that's an option. There is also teacher loan forgiveness. So if you are a teacher, there is a whole teacher loan forgiveness program to get, it's up to $17,500 of your loans forgiven, as long as you meet all of the qualifications for that. And then there's Perkins loans cancellation, which is very similar in that you have to do public service, teaching, something like that in kind of Title I areas to qualify for, but they will cancel out your loans. You can find information on all of that at studentaid.gov. If you go to studentaid.gov and manage loans, they have an entire section that talks about all the different types of forgiveness and cancellation, what that means, what that qualifies for. So you can go in and you can get a lot more detail on those. Okay, and then there's discharge. There really is not a whole lot of ways to get discharged from a student loan. And that is why we really stress caution to anybody who is considering taking one out. There is total permanent disability. So if you are completely disabled 100%, you cannot work anymore, you can apply to have all of your loans discharged. I I would caution though, because I've seen it happen to friends of mine and I've heard many stories of it happening. If you suddenly become better, if whatever illness you had that made you disabled miraculously heals itself somehow, or, you know, you were disabled for whatever, you had lupus and you could not work and it went into remission and now you can work again. Those loans will come back due if you start working again. So just keep that in mind if you're ever in that situation. There is death discharge. Of course, if you pass away, then your student loans go away with you, which of course makes me feel a lot better because that means my kids, my, you know, grandkids will not be responsible for my student loan debt. But it is something to know that if you pass away, your federal student loans go away with you. There is also a few other things. There's closed school discharge, which is if you are like actively going to a school and the school closes down while you're in school, that is they will discharge your loans if it closed while you were attending. There's a lot of stipulations to that, so I'm not going to explain it a lot more than that, than to tell you to go to studentaid.gov and read about it if you're interested in knowing more. There is the false certification discharge, which again, you really have to have a lot of documentation of things being certified incorrectly in your financial aid office to qualify for that. And then your unpaid refund discharge, which is if you say you took out a loan for $5,000, you decided you only needed $1,000 and you gave back that other $4,000 to your financial aid department, but they never sent it back to the Department of Education, you could get that extra $4,000 discharged. However, you have to have proof. And so if you don't have proof showing that you gave it to them and that they didn't do it, you're kind of out of luck there. So again, if any of those circumstances apply, I would go to studentaid.gov and read more about it. So now here's a bunch of resources. I'm going to copy these all and put them in the chat. Well, maybe I will. Or maybe I'll do that afterwards because it's not letting me. So this is a lot of different resources that you guys can use. There is readysetrepay.org, which is actually an initiative of Oklahoma College Assistance Program. It is one of the initiatives that I support, and it is everything student loan repayment is what we deal with that. We also have a Facebook page for that. Oklahoma Money Matters, which is the other initiative from OCAP that I support, which is Oklahoma Money Matters. It's financial literacy, so budgeting, managing your money, savings, credit, all of that information. Lots of good stuff on our website and our Facebook and Twitter pages for that. These next three are actual publications that if I was able to come out and speak to you guys, that I would have brought with me. The first is what we call Borrow Smart from the Start. It is a brochure that talks all about all of the stuff that I have talked about today, borrowing, smart student loan borrowing. And then the next is your repayment calculator that talks about, or repayment calendar, excuse me, talks about when, if you graduate in May, when is your new payment going to be due, etc. If you graduate in August, when is that going to be due? So you kind of know what that looks like. And then the student loan terminology, that is literally just what it says. It is all of a whole bunch of student loan terminology, so you know what that means while you're dealing with student loans. There is studentaid.gov. I've mentioned it a bunch of times. And because I know that a lot of people right now are having questions about their student loans as far as, COVID-19 and the CARES Act and all of that stuff, I included a couple of websites. Studentaid.gov actually has an entire website just on FAQs about the coronavirus. So it's studentaid.gov/coronavirus, as well as studentaidpandemic.org. They have a lot of information too. So, all right. That being said, here in a minute, I will copy that into the chat so you can get those. But for now, what questions do you guys have?
Hey, Sarah, I just wanted to add one more resource is I'm a certified student loan counselor. So if you have any questions, I'm going to put my information, especially if they're personal questions to your situation, I'm going to put my contact information in the chat and you can contact me and make an appointment.
Fantastic.
Hey,
Thank you
Sarah,
very
I had
much
a
for that.
question.
Yeah.
Can you talk again about earlier whenever you were talking about when you and your spouse have student loans? Can you talk about filing jointly again or filing separately? What did you recommend on that?
I didn't actually make a recommendation on that. It really is going to depend on your own circumstances. I just wanted to mention that one of the things that people tend to do in that situation is file separately from your spouse. That is going to depend on whatever is the best situation for you. You could definitely go talk to, like, if you have a CPA, talk to them about which would be the best option for you guys when it comes to that. Talk to your student loan servicer, see what that is the best option. You know, in my case, whenever I was married, my ex-husband didn't have any student loans, so it wasn't really a problem for us. You know, we filed together. It didn't really affect a tremendous amount my student loan payment because we made enough money between the two of us that the fact that it was a little bit higher didn't really affect us. But you know, now that would be a different story because at the time I was working at a job that made a lot more money. And so that wasn't the case. But now that I'm back working in, you know, government and not-for-profit sector, definitely that would change. So I would just recommend, like I said, reach out to your CPA, whoever it is that does your taxes, talk to your student loan servicer. Okay, what other questions do you guys have? Okay, and I just put all of those links, there's a whole bunch of them, in the chat for you guys, so you can get to them. All right, so we got no other questions? Awesome. Okay, I'm actually surprised. I was expecting somebody to ask about the COVID-19 stuff, but I think they've done a pretty good job of trying to kind of get that out there, where I haven't been getting as many questions about it. Okay, well, it is 11:02. That is all I have for you guys. Thank you so much again for letting us come and speak. If you have any questions, let me share my screen again. Hold on one second. Okay, if you have any questions, this is my contact information. We are not in the office right now, we're working remotely. So if you have any questions, feel free to reach out to me via email. I will do the best that I can to get that back to you. You know, reach out and answer for you. All right, again, thank you guys. I'm gonna go ahead and end the meeting and you guys have a great day.
Thank you so much, Sarah.
You're so welcome.